The US government's debt rating has been downgraded, but what does this actually mean? Are we fast on our way to a Mad Max-style apocalyptic wasteland where money doesn't matter, or is this kind of being blown out of proportion? We're talking all about it in today's video. Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video we are talking about the recent downgrade of the United States government debt. Now, I know I'm a little bit late to this party, but I thought this was important to talk about because this is a topic that is both incredibly meaningful and significant, but also has the possibility to get blown out of proportion. So in today's video, I want to explain what the debt downgrade means, why we were downgraded, and what this could mean for the future. Obviously, this video is not financial advice and is just my economic speculation. So with that being said, let's jump right into it. This article from US News says that late Tuesday, Fitch Ratings became the second of three major credit rating firms to remove its coveted AAA assessment of the United States government's credit worthiness. So, what does this even mean? Basically, when the government issues debt, the government has more programs, it has more services that it needs to pay out for than what it takes in tax revenue. So what it does is it issues bills, notes, and bonds. But for our purposes, let's just call it government debt. So the government issues debt, and they say, if you give us $1,000 at the end of some period, 30 years, 7 years, 5 years, we're going to give you that money back. Not only will we give you your money back, but we're going to give you periodic interest payments along the way. And because this debt is backed by the full faith and credit of the United States government, we're the most powerful economy, we are the most powerful military, you pretty much know that you are going to get your money. And U.S. government debt has traditionally been seen as the safest, risk-free investment that you can get. I remember when I was going through my licensing exams and they were talking about different customer profiles. What would you recommend for someone that is saving for a home? What would you recommend for someone that is very risk averse, right? When we had to do these exercises and match customers to investments, they always told us that government debt was for people that were very risk averse, people that are perhaps in retirement, people that need the money and don't want to lose their principal. So having that AAA rating is a bit of assurance for those investors, the people that don't want to lose their money. So obviously going down from a AAA to a AA plus isn't the end of the world, but people don't like to see negative progress. They don't want to begin that slippery slope, right? Because as Americans, we've been at the top of the economic powerhouse for a long time. We've had that AAA rating, and when people start to see things going the wrong way, they start to ask questions. Specifically, Fitch is asking questions about the United States government. It's saying, hey, you have a rising debt burden and political difficulties in addressing spending and tax policies. So basically they're saying, you've had this AAA rating, but we're seeing some things here that we don't like, things that make it just a tiny bit less likely that you deserve this AAA rating. And to be honest, I agree with them. If we look back at the past couple years or months, how often does the government shut down? Remember just a few months ago, they kept telling us, oh, the government's going to run out of money, the government's going to shut down. This isn't a one-time thing, right? I think countries, people, right, whatever the case is, all of us get into situations that we need to fix, right? But the government keeps running into the same problem over and over and over, right? And this is becoming an issue for these rating agencies. They're saying, hey, you didn't just have a one problem and you fixed it and now you're on a path to financial sustainability. You had a debt problem and you just perpetually every couple months push this thing down the road by increasing your debt limit. Not only that, but they're saying the debt itself is becoming a problem. If we look here at the debt clock, we can see that the debt per taxpayer is $253,000. Now, this is, in my opinion, one of the most important metrics to look at because people will always say, the national debt is $32 trillion, and what does that actually mean? This is why I like looking at the debt per taxpayer, because it says out of all the people that actually pay taxes, right? People that are able to work, people that contribute to the taxation structure, right? 253,000. Let's just round it and call it $250,000 per taxpayer. Do you know what the average American salary is? The average American salary is about $56,000. So in order to pay this debt off, we would have to take every single penny that the average taxpayer makes for somewhere between 4 and 5 years. I don't know how they're going to survive and eat and have food and shelter during that period, but we would have to take all of their money during that period. Not only that, but let's forget about their wages. Let's forget about their earnings. Let's just take everything they have. If we look at the average net worth of American families. Now, we're going to be using the median in this example because it reflects the average a lot better than the mean, but the average net worth as described by the median value for Americans goes somewhere between, you can see, $14,000, $91,000, up to about $266,000. So even if we take the wealthiest Americans and we take everything they own, not just their salary, not just their pension, not just their taxes, we sell their house, we sell their stocks, we sell their cat, we sell their dog, we sell everything they own, we still do not pay back this debt, right? So I think that's important to think through because this is something that Fitch is looking at. This is something that these rating agencies are looking at. And they're saying your debt just keeps going up. You don't make any progress on increasing your tax revenue or bringing your debt down. And again, I'm not trying to be political here. There's two ways of bringing down the debt, right? Decrease spending or raise taxes. And what Fitch is saying is they're saying, hey, we don't really care which way you do it, but the fact is you're not making progress on it either way. So obviously it's something pretty significant, but this is not the first time that the U.S. debt has been downgraded. If we look back to 2011, we had an event known as Black Monday when the U.S. debt was downgraded for the first time. And as you can see here, there was some pretty significant impact on the stock market. The Dow Jones Industrial Average lost about 5.5%, so a major drawdown there. But if we look back at the S&P 500 over the past couple weeks, we can see that the impact really hasn't been as massive and earth-shattering as it was back in 2011. Yes, the S&P 500 did have a little bit of a dip, but nothing absolutely crazy. We can also see that cryptocurrency as well as gold, in my opinion, didn't have some off-the-charts reaction, right? Obviously, they moved a little bit, but there's nothing here that looks like this is an earth-changing event. And another thing, if we look at the yields on treasuries, there doesn't seem to be hardly any movement at all. So what does this all mean going forward? Before we explain that, I've got to drive home one key point. Anytime we think about an investment, there is a trade-off between risk and reward. If you are proposing a very risky investment, I'm going to want a very high reward to compensate me for taking that risk. On the flip side, if I know my money is pretty much safe, I'm going to be content with a lower interest rate. So in theory, as the risk of U.S. government debt goes up, we should see the interest rates or the yield on that debt rise. Now, that's kind of the theoretical scenario. There's also a psychological dimension that people are concerned about. They're saying, what if we lose that perfect status and we don't just see a little bit of an increase in the yield? What if people just completely dump the bonds on the market because they're not perfect status anymore? I don't think that's likely, and I'd like to share some data and information to back up that point. If we look here, you can see that I have plotted various duration government bonds. So we're talking the 5-year, the 7-year, the 30 30-year. I've plotted them here on this chart. You can see at the right of the chart we have 8-1, which is August 1st before the debt was downgraded, and then you can see we go all the way to the 11th after the downgrade, and there is virtually no movement in these interest rates. There's a little bit of a movement, but nothing massive or earth-shattering, right? We're not getting downgraded to junk bond status. We're not in default. So this idea that pension funds, hedge funds, retirement funds, that they're going to just dump government debt, in my opinion, does not make a lot of sense, because we're still at the AA plus rating. We've been downgraded in the past in 2011, and even after 2011, government debt was still the highest rated form of debt. So in my opinion, this idea that government debt is just going to be trash and that bondholders are going to lose everything just doesn't really add up. It's a little bit of an overreaction in my opinion, because at the end of the day, we still have a very high debt rating. But I think the thing, again, that people don't like to see, if we look at this chart, we might have a AA plus, the same as New Zealand or Finland, but we have a negative outlook. And this should really be, in my opinion, a warning shot for the United States. Yeah, a AA plus rating isn't bad, but a AA plus rating with a negative outlook means that we need to start turning things around. We need to look at our finances, because what if we go down to an A plus? What if we go down to BBB, right? As we continue down this path, it makes it more costly for the United States to borrow. We have to, instead of offering a bond with a 5% rate, now we've got to do 7, 8, 9, 10% rate. The higher the interest rate is, the quicker we rack up more debt, and it becomes a cycle. So, long story short, the U.S. government debt downgrade, at least for the short term, I don't see as a massive market mover. However, it should be a warning shot for us that we need to start looking at our finances, or we face the possibility of further debt downgrades, having to pay more interest to service our debt, and accelerating this debt cycle that could potentially lead to consequences at some point in the future. Again, these are just my thoughts. These are my speculations. They are not financial advice, so please do not make any kind of investing decisions based on what I said here today. I hope you enjoyed the video, and I'll see you next time.